The first Bank of India was Bank of Hindustan 1770 under British rule. The banking system in India was controlled by and dominated by presidency banks. There were three presidency banks: Bank of Bengal 1806, Bank of Bombay 1840, Bank of Madras 1843. They were called presidential banks. All merged in 1921 to Imperial Bank of India, which was changed in 1955 to State Bank of India. Commercial bank refers to banks which are a large division of bank which more specifically differs to deposit and loan services provided to corporations or large middle-sized business as opposed to individual members of public small business. They do not provide long-term credit as liquidity of assets is to be maintained. Commercial banks are institutions which conduct business with profit motive by accepting public deposits and lending loans for various investment purposes. Functions of commercial banks: primary, secondary, other functions. Primary functions are accepting deposits, advancing loans. Secondary functions are agency services, general utility services, transfer of funds, credit creation. Commercial banks also undertake task of underwriting securities. As public has full faith in the creditworthiness of banks, public do not hesitate in buying the securities underwritten by banks. Electronic banking includes access, debit cards, credit cards, and internet banking. Other functions: money supply. It refers to important functions of commercial banks that help increase in money supply. For instance, a bank lends 5 lakh to an individual and opens a demand deposit in the name of that individual. A bank makes a credit entry of 5 lakh in that account. This leads to creation of demand deposits in that account. The point to be noted here is that there is no payment in cash. Thus, without printing additional money, the supply of money is increased. Credit creation. Credit creation means the multiplication of loans and advances. Commercial banks receive deposits from public and use the deposits to give loans. However, loans offered are many times more than the deposits received by the banks. This function of banks is known as credit creation. Collection of statistics. Banks collect and publish statistics relating to trade, commerce, and industries. Hence, they advise customers and the public authorities on financial methods. Technique of credit creation by commercial banks. Bank credit refers to bank loans and advances. Money is said to be created when the banks, through their lending activities, make a net addition to the surplus supply of money in the economy. Money is said to be destroyed when the banks' loans are repaid by the borrowers to the banks, and consequently, the credit already created by the banks is wiped out in the process. Banks have the power to expand or contract demand deposits, and they exercise this power through granting more less loans and advances and acquiring other access. This process of power of commercial bank to create deposits through expanding their loans and advances is known as credit creation. Modern banks create deposits in two ways: primary deposits, direct deposits. When a customer gives cash to the bank and the bank creates a book debt in his name is called deposit, is known as primary deposit. But when such a deposit is created without there being any prior payment of equivalent cash to the bank, it is called as derived deposit. Primary deposits that bank makes loans and advances to customers. The initiatives taken by customers themselves. In this case, the role of the bank is passive. So these deposits are called passive deposits. Credit creation means the multiplication of loans and advances. Every loan creates its own deposits. Central bank insists the banks to maintain the ratio between the total deposits they create and the cash in their possessions. For the purpose of understanding, it is assumed that all the banks are obliged to keep the ratio between the cash and its minimum deposit and its deposit minimum 20%. The banks do not keep any excess reserves. In other words, it would exhaust possible avenues of income earning activities like giving loans, etc. There are no drains in the supply of money. The public do not suddenly want to hold more ID in currency or withdraw from the drains. Under the above assumptions, when a customer deposits a sum of 1,000 in a bank, the bank creates a deposit of 1,000 in share. Bank deposits, bank money have increased by 1,000, but at this stage there is no increase in the total supply of money with the public. Because of the above, extra bank money of 1,000 is offset by the cash of 1,000 deposited in the bank. The bank has no additional cash of 1,000 in its custody since it is required to keep only a cash reserve of 20%. This means that 800 is excess cash reserve in it. According to the above assumption, The bank should lend out this 800 to the public. Suppose it does so, and the debtor deposits some money in his own account with another bank. Um, Bank is creating a deposit of 800. Bank B then has a excess cash reserve of 640, and it should soon lend out 640. This 640 in turn find its way to Bank C. It will create a deposit of 640 and so on. The total deposits will grow into 1800 640 until immediately the excess cash reserve peters out. It has shown that when the stage has reached, the total of will be 5000. Money multiplier is equal to 1 by 20% is equal to 1 by 20 by 100 is equal to 1 by 20 into 100 is equal to 5. Credit creation is 1000 into 5 is equal to 5000. Role of commercial banks in economic development of a country. Capital formation. Banks play an important role in capital formation. They mobilize the savings of the people scattered over wide area through the network of branches all over the country and make it available for productive purposes. Capital. Role of commercial banks: capital formation, creation of credit, channelizing funds, encouraging right type of industries. Banks monetize debt, finance to government, employment generation. Banks promote entrepreneurship. Non-banking financial institutions are companies that does not have full banking license, is not supervised by the central bank. They do not carry on pure banking resources, but they will carry on other financial transactions. They receive deposits and give loans. They mobilize people savings and use the funds to finance expenditure on investment. In short, they are institutions which undertake borrowing, lending. They operate in the money and the capital markets. NBFIs are broadly classified into two categories: stock exchange, other financial institutions. Under the latter category comes finance companies, finance corporations, chit funds, building societies, issue houses, investment trusts, unit trusts, and investment commissions. Central bank, reserve bank, or monetary authority is an institution that manages state's currency, money supply, and interest rates. Central banks are usually commercial banking system of their respective countries. Function of central bank. Reserve Bank of India, central banking institution which controls the monetary policy of the Indian rupee. It commenced its operations on 1st April 1935 in accordance with the Reserve Bank of India Act 1934. The original share capital was divided into shares of 100 each, fully paid, which were initially owned entirely by private shareholders. Following India's independence on 15th August 1947, the RBI was nationalized on 1st January 1949. It controls monetary supply in the economy. Monetary authority, issuer currency is objective to maintain currency and credit system of the country. It is authority issue currency. Issuer of banking license as per section 22 of Banking Regulation Act. Every bank has to obtain a banking license for RBI to conduct banking business in India. Reserve Bank of India was formed on April 1st, 1935 in accordance with the RBI Act 1934, nationalized on 1st January 1949, fully owned by Government of India. Headquarters moved from Calcutta to Mumbai in 1937. Osborne Smith was the first governor of RBI. It is a central bank regulator for all banks in India, also called lender of last resort. Governors and 4 deputy governors, along with the central board of directors appointed by Government of India, issues currency banker to the government. It collects receipts of funds and makes payments on behalf of the government. Regulator of Indian banking system, custodian of forex, control of credit. The process of issuing the paper currency was started in the 18th century. Private banks such as the Bank of Bengal, the Bank of Bombay, and the Bank of Madras first printed paper money. First money rupee was introduced by Sher Shah Suri based on a ratio of 40 per pieces paisa per rupee. The name was derived from the Sanskrit word rupaya, meaning silver. Each bank note has its amount written in 17 languages, English and Hindi on the front, and 15 others on the back, illustrating the diversity of the country. Bankers to government is bankers to central and state governments. Bankers Bank RBI is the bank of all banks in India, provides loan to banks, accept deposit of banks and rediscount the bills of banks. Lender of last resort banks can borrow from the RBI by keeping eligible securities as collateral at the time of need of crisis or when there is no other source. Acts as clearinghouse for settlement. The RBI manages voting clearinghouses. It facilitates the exchange of instruments and processing of payment instructions. Custodian of Forex, it administers and enforces the provision of Foreign Exchange Management Act (FEMA) 1990. RBI buys and sells foreign currency to maintain the exchange rate of Indian rupee versus foreign currencies. It controls economic system monitors different key indicators like GDP, inflation. It's a regulator of economy, managing government security. RBI administers investments in institutions, secretary and supervisor of payments and settlement systems. Act of 2007 gives RBI override authority for the payment and settlement systems in the country. Development role, development for quality banking in India and ensuring credit is available to productive success of economy. Publisher of monetary data and other. RBI maintains and provides all essential banking and other economic data. Exchange manager and control. RBI represents India as a member of the Indian Monetary Fund (IMF). Banking Ombudsman Scheme. RBI introduced the Banking Ombudsman Scheme in 1995. Under this scheme, the complaints can file their complaints in any form. Banking Codes and Standard Boards of India. RBI set up the Banking Codes and Standard Boards of India to measure the performance against codes and standards.